So Maroun, it is an exciting part of the market and an evolving part of the market. But when you think about sort of that AI theme and those large mega cap tech names, what are some of the challenges you think in terms of, particularly that a lot of those stocks have done really well? So what are some of the challenges you think about?
Yes, there's a few. I mean, the first will be valuations, right? These predominantly US names, mega cap names, are trading at valuation levels in excess of their long-term history. If you look at a 20-year history, they're trading at levels in excess of that as a group. Now, why that's important is valuation levels give you an insight into what the market is pricing in terms of its expectations for those companies. So the bar is very high. And it's one thing to be able to grow quite rapidly when you're small, but as you get larger and larger, maintaining that same percentage growth rate gets a lot harder. And you've got some of these companies now that have got market valuation levels larger than developed economies. I mean, there's a handful of companies in the US that have market valuations bigger than the entire Australian economy. So it's staggering that these companies of this size need to maintain such an exceptional growth rate going forward to keep investors in the broader market happy. So that's the first thing. The second thing I would say is the nature of their business model is changing. One of the factors that investors loved about these companies historically is that they were relatively capital light. You could grow without investing a huge amount of money. If you think about Microsoft, for example, once you created a version of Windows, you could just sell it and sell it and sell it for relatively low cost, incremental low cost. Google could just add users to its platform without a huge amount of additional costs. So it was quite capital light. You didn't need to invest a lot of money to get larger. AI is now a game that is quite capital intensive. You need to buy chips, which are very expensive. You need a huge amount of storage or cloud, whether that's your own data centers or you rent that out from third parties. You need complex LLMs, models, etc. So it's quite capital intensive. And if you just took 4 companies, for example, Amazon, Google, Meta, and Microsoft, and you looked at their CapEx profile 10 years ago, collectively, those companies did about $23 billion in CapEx back in 2014. That number today is more like 240 billion. So they've actually grown their CapEx profile 10x in 10 years, which is quite a large growth rate. So they now need to earn the same rates of return or very high rates of return on a much larger invested capital base, which again makes it very hard. The other part I would say is there's an increasing amount of circularity that's building into these companies with OpenAI seemingly sort of at the middle of this web. So you've got some of these circular transactions, like OpenAI is pledging to buy a huge amount of chips of NVIDIA for the next decade, and in return, NVIDIA is investing in OpenAI. Similarly, OpenAI is pledging to rent a huge amount of cloud capacity from Oracle, and in return, Oracle is going to invest in OpenAI. OpenAI has a similar relationship with AMD, where they're going to buy a huge amount of chips from AMD going forward. And so now these companies are becoming tied to one another in a way that's deeper than just the pure sort of customer relationship way. And that sort of has some similarities or some shades to what we saw during the dot-com bubble. Back then, we had this concept known as vendor financing. So if you were a cable company and you wanted to build out your cable network, you could go to someone like a Nokia or Alcatel-Lucent, and then you could get vendor financing where they would lend you the money that you would then use to buy product off them. And so those companies became intertwined. We're sort of seeing elements of that, coming in more recently, like literally in the last 2 or 3 months. And so that I think is, it's not necessarily bad, but it's increasing the level of systemic risk, because you can have a scenario where if one domino falls, it has a cascading impact on a whole bunch of other companies, and very quickly you can have contagion feeding throughout the system there. So the risks are becoming a little bit more elevated.